Thank you, Mr. Bhatnagar, for the introduction. Ladies and gentlemen, it's always a very tough job to address a group immediately after lunch, but I'll do my best to wake you up. Harish's presentation and challenging thoughts on downstream, I'm sure, would have been an awakening for all of us. The topic for my speech today is about profitability and how the sector is facing issues in terms of the operational performances. Trust me, as an industry practitioner, I'm just like Harish, I'm extremely bullish on this sector and do believe that the sector in India has a lot much more to offer than what we've seen in the last 5 to 7 years. Having said that, the time that we are going through is painful. The challenges that we're facing right now are real, and whether we like it or not, those next 2, 3, 4 years or whatever time it takes, the landscape of the industry is going to change. We're going to see huge amount of transformations, changes. They're going to be pain felt by the industry players. I won't be surprised if many of the names that you find in the roster list of people who put up generation plants and likes of those would not be there to be seen in 2015. It's also a time when I totally believe that our policymakers and the government would be pushed to the wall in a classical Indian way, and they will have no other alternative to come out with reforms that will eventually work for the betterment of the industry. Having said that, let me try to give you a sense of how we see the changing fortunes of the sector. I'll start off with how the sector has performed. It's always good to start off with a bit of self-patting as an industry on this. But when you get into what are the changes that's happening, what implications is this happening on the financial performance of the organization. I will then, the second half of the presentation, we've all since morning spoken about what government should be doing, what industry should be doing. We'll focus more on what we as individuals and we as corporations, how do we introspect, how do we look inwards and see what best can we do of this particular situation. All right, to start off with, last 6, 7 years has been a euphoric sort of a phase for us. The generation capacities have gone up. For the first time in the history of the Indian power sector, we added 10,000 megawatt of generation capacity. We saw phenomenal shareholder value creation, coming out from Gujarat. I'm sure 95% of the people sitting out here invest in stock markets. All of you guys would have made significant amount of returns if you've had exposure to the power sector companies and corporates over the last 4 to 5 years. Elements like trading volumes, however small it may have been, however constrained it would have been, even reforms like, trading and IEX and others has seen a significant growth. And we saw massive news headlines coming out of it. Reliance Power IPO of $2.5 billion, $6 billion of private equity investments coming in, people, big names in this space investing in projects which were on the paper were betting high for the future. Private sector adding to about 50% of the incremental capacity, increasing its share from 1% about 10 years back to about 20% now. So significant amount of growth and investments is what we saw over the last 6 to 7 years. It was also a time when many of the early adopters actually saw fantastic and phenomenal returns. Take the example of Jindal Power, probably one of the first merchant power in the private sector to come out. This was a scenario where the trading prices were ruling very high, and they were able to sell, power at 6, 7, 8 rupees per unit. Some of the numbers that you see, and if you are an industry practitioner, you'll be amazed by these numbers. You're making a revenue of about 4,000 crores. It's almost an asset turnover of 100% on your investments. You have EBITDA margins of 85 to 90%, return on equity of 60%. Tell me a business where you can get 60% plus kind of an investment return. Similarly, some of the other businesses have made money. This was a scenario that was building in. Obviously, the time was right. They were one of the first few people to come in, and that's why they reaped the benefit. But what that led to was almost a beeline of investments chasing up. We've had calls as organizations. We've had calls from Bhujiawala companies and others saying, we've got cash to spare, I want to invest in the power sector. So, what was happening was there was almost an unrealistic expectation that was getting built around as to this power sector is now the next gold mine that is going to give phenomenal returns to us. And it's not just the industry that got fooled by it. You had these sophisticated investors in terms of the private equity, the secondary market that was putting in money, giving valuations of millions of dollars on projects that were not even out there in the market. So that's what was happening. If you compare the returns that we were seeing vis-a-vis some of the other infrastructure projects, again, it was on a much higher side. Power saw an average ROE, leave out the Jindals and Torrent that I shared, even an average ROE of about 20 to 25%. Compare it with any other infrastructure projects, right? You don't get those kind of ROEs. As industry practitioners, the very fact of an infrastructure project construct is it's always a high payback, low beta, moderate return kind of a business. You do not operate, and you never get a 20, 25%. Now, there can be an argument that given the so-called risky sort of scenario under which we operate, obviously the equity holders or the shareholders will demand a higher return on their capital vis-a-vis some of the other markets. Yes, but some of these numbers that were there were still on the higher side. And similar thing we saw on the EBITDA margins and so on and so forth. So there's almost, I would say, a mini bubble kind of a scenario that got built up, driven by some kind of almost an unrealistic expectations, if I were to call, sort of coming up in the generation space. Now, what has happened now? Given all these things, obviously the reality had to hit, and the writing was pretty much on the wall. What we are seeing now are obviously issues and challenges that affect both the capital investment side of things as well as the operating performance side of things, right? We are clearly seeing scenarios where the capex is increasing substantially. We used to talk about 3.5, 4 crores per megawatt of investments about 5 years back. Right now, below 5 crores, you can't even think of a thermal, coal-based power plant coming up. I won't be surprised over the next 3 to 4 years, you're talking about numbers of about 7 crores per megawatt as just the capital investment requirement going into this. Coupled with the noises that we're hearing on imposing duties on the Chinese equipment being brought in, on the land sector reforms, and hence the land acquisition costs going up, and so on and so forth, right? So that's, on one hand, that's happening. Secondly, the cost of funds are increasing. A lot of investments were planned. A lot of PPAs were signed when the cost of debt was 8, 9, 10%. We're already seeing the cost of debt going up to 12, 13, 14%. How the future holds is for no one to, it's for everyone to predict, but, we're definitely seeing pressures on that. Given all these scenarios, it is extremely likely that the capital expenditure on per megawatt for projects the new projects that will be commissioned can go up by anywhere between 30 to 40% in the next 3 to 4 years itself. Now that's on the capex side. What's happening on the market side, right? There are clear-cut pressures on the merchant prices. The merchant prices, long-term average trends of merchant prices are coming down, despite the recent momentarily spike in the prices that you've seen because the coal has not been available, hence the production has not been there. The long term, if you were to map the long-term trend of merchant prices, it is on a downward trend, and rightly so. There is absolutely no justification to a merchant price trading at 7 rupees when the PPA prices are going at 3 rupees. You mark any of the global markets, the premium that you get on a spot prices vis-a-vis the long-term prices would at best be 15 to 20%. So there is an automatic market level correction that is happening. It's much more stark out here because the downstream sector just does not have the money to pay for a 6, 7, 8 rupees. So they are resorting to load shedding, but they cannot buy power. So the merchant prices pressures would be there. There'll be fuel availability constraints. We are already seeing issues on the same. There is absolutely no short-term solution to that, right? No matter how much of prophecies, no matter how much of talk we do right now, there's absolutely no short-term solution to this. The sector will go through issues. What that will result in is the PLFs will fall, right? The new power plants, their business plans were all built at 85 to 90, 92% PLFs. In all realities, even the new power plants, if they operate at 70% PLF, I would consider them lucky. That's on coal side. Similarly, on gas side, even worse of a situation. So the PLFs are falling. Third is on the fuel side. The cost of coal, the cost of gas, the average basket of fuel that we as a power sector enjoy is going up, will continue to go up. If you were to look at the macroeconomic situation of the country, one of the biggest problems for all the rupee depreciation that you're seeing, of all the problems that you're seeing right now, is the fiscal deficit pool that the country is going through. As a country, we just do not have the bandwidth to do any more or take on any further sort of subsidization on the energy side. So the government has no flexibility whatsoever to start cross-subsidizing. And coupled with the fact what Vikas was talking in the morning, where our energy portfolio, and what Harish, you also referred to, where our energy portfolio, over 35 to 40%, is exposed to the global markets, going up to 40-45% in the recent future, there's absolutely no other way but the cost of fuel, the average cost of our energy basket, will go up significantly. Our base rate sort of a projection is we will see an inflation on the fuel of at least 10 to 12% per annum, substantial over the next few years. So don't be surprised if you were thinking of a cost of generation of power from coal at about 2 to 2.2 rupees per unit to jump to about 3.5 to 4 rupees per unit over the next 4 to 5 years. So now that's going to be, so what's happening is my capex is going up, my operating costs are going up, but I'm not able to pass on those increase in costs to the downstream because I have pressures on the pricing side, whether it's on the merchant side or the competitive prices on PPA, is just capping the amount of pressures that we will get. What that will result is automatically, there has to be a pressure there has to be pressure on the profitability. This is the scenario that we've been so far working as an industry. Typical, everything said and done, the cost of production has been anywhere between 2 to 2.5 rupees. Obviously there have been plants which are operating at about 3 rupees. There are pithead-based, high-quality coal plants which are still able to do it at 1.6, 1.7 rupees. But on an average, this is the broad industry benchmark. Industry is typically able to garner anywhere between 2.6 to 3.2 because they do a blend of PPAs versus merchant power, and hence that's the average tariff that they are able to get. Fast forward and look at what the scenarios will look at. With increase in the fuel cost, with increase in the O&M cost, with increase in the interest rates, depreciation, and capital expenditures that we want, we will see a scenario where majority of our power generation, even coal, which is by far the cheapest cost of production, will go up to 3.2 to 3.5, on the higher side even up to 4 rupees per unit. And we don't expect the average prices that will be realized to shoot beyond 4 rupees per unit. The average inflation that we saw on the prices front over the last 10 years has been 3% per annum, right? Even if you double that over 6% per annum, the balance that you will get will be about 4.2, 4.3 at best. So the headroom of about 30 to 35% over the cost that we were seeing so far suddenly squeezes to about 10 to 15%. What that results in are obviously your return on equity has to come down. It will moderate down to 14 to 16%, which will come along with the EBITDA or the operating margin returns. Now, once you see these numbers, if I were an investor, it's not a very healthy sign because it's high amount of investment that I do, and the industry is inherently risky. There is high risk, there are government controls, there are inefficiencies, and I'm looking at an ROE of 15 to 16%. There are still infrastructure projects that are giving me better returns than what these are, right? The point that I'm trying to say is, no matter what it is, this is a reality that we will have to face, and this is the challenge that we as a sector are confronting. What that will result in is, and this is just a chart that we've tried to map out on some of the new projects that are being planned or under commission and so on and so forth. So if you look at about 70,000 megawatt of projects that are in different stages of evolution, almost get bucketed into 3 different buckets. There are projects which are low-cost projects. Many of these and most of these have access to fuel, captive coal, and so on and so forth. There are medium-cost projects which are depending on a blend of domestic fuel. Some of them are imported coal-based and so on and so forth. And then there are a lot of high-cost projects which were completely import coal-based or even gas-based projects. If you were to look at what kind of prices they need to even get say 17 to 18% ROE, which any of the investors would require, we're talking about even the medium segment asking for about 3.5, and the higher segment asking for 4.5 to 6 rupees. Most of your conventional wisdom and most of the wisdoms to say, I don't see a 4.5 to 6 rupees as the net realization of power coming out. Now, if that works out, almost 40 to 50% of the projects that are being thought about, that are being envisaged right now, will become unviable and faces the issue of either getting delays or being scrapped in the middle. There are already projects, which have been done. So whether you're hearing about, our power talking about the UMPP project, the Tata Mundra project coming out, Sterlite Energy canceling the 4th unit on Talwandi, Sabu, and so on and so forth out here. This is by far the transitionary phase, but one of the biggest challenges that we're facing as an industry. And this is precisely the reason why, we believe when I stood up and said, over the next few years, we're going to see a lot of players who've been on the fringes, who've been on the marginal side, who've not got their basic elements tied up, being constrained and getting wiped out. So what does it mean for us? Very quickly run through, imperatives for the industry. Obviously we are talking about a lot of external reforms and other elements that has to drive it. But let's also take some time out to introspect and look at how can we tighten our belt on cost front and on the CapEx side. Look at how are we allocating CapEx. What's our strategy? How are we optimizing CapEx across projects? How are we ensuring that we take a life cycle sort of a view of the capital projects and not just buy the cheapest, boiler, turbine, generators, and others, and bundle them right up front. Also look at how best can we reduce the cost, whether it's on the O&M side, whether it's on some of the other elements that we are talking about. In our experience, you can squeeze anywhere between 10 to 15% if you really tighten your belt. So last slide, point taken, last slide from my side. It's important for all of us as industry players to go back and introspect and ask yourself questions on, is my basic business model under threat? Do I see threat to my profitability and long-term viability? Do I have proactive strategies defined to address the same? Is my organization capable enough to define to address these risks? And what kind of steps do we need to take to drive some of these elements? Thank you very much.